This week from Boise, Idaho, it's live, or at least live if you're listening right now. It would be taped otherwise. The current federal tax developments for the week of October the 29th, 2018. Current federal tax developments are brought to you each week by Kaplan Professional Education and by your state Society of CPAs. As I said, this week I am attempting to broadcast live from the Riverside Hotel in Boise, Idaho. And hopefully the throughput is good enough that the quality will be at least decent for this week's broadcast. Hopefully we're not pushing too hard on anything. And we've had a few things happen this week. Now, like last week, I don't really have a whole lot written up, largely because I've been on the road. I've been traveling. Actually, this week I was on Long Island to start the week. Went up to Rochester, New York in the middle of the week. Closed out the week in Providence, Rhode Island, and then I got back to Phoenix. Had a few hours, and then I had to get another plane, get here in Boise, Idaho, which is why we're recording this from Boise. Where I'll be doing a couple of days of sessions this week for the Idaho Society of CPAs, and then go back to Phoenix, finally get a little bit of rest at home, and also do the federal tax conference, Federal Tax Institute, I should say, for the Arizona Society of CPAs. I'll be speaking at Friday, closing out the session. We have that Thursday and Friday coming up. Follow that up the following week with going to a tax conference in Portland. So moving around a bit, and then I'm off to Tucson for sessions there. So I've got a few things happening. In any event, though, things have been happening in taxes too. This week, we're going to take a look at a ruling. It's not really tax, but it is one that affects how we look at certain things. And we had a court rule, basically for a Minnesota case, that a individual who received an IRA and a qualified plan balance in his divorce proceedings, basically divided the IRA under the code, divided the qualified plan with a qualified domestic relations order. The bankruptcy appellate panel for the 8th Circuit found that it wasn't protected in bankruptcy. We're going to talk to you about some OMB stuff this week. One thing, the interest limitation proposed regulations are actually now at the Office of Management Budget, so good news. We expect to have those regulations, the IRS is telling us, by the end of November. We also have related, the OMB also published some plans for future guidance. And good news, the Tax Cuts and Jobs Act loss limitation rules. We plan to have some guidance on that $500,000 or $50,000 limitation. Bad news is we won't get it till June of 2019. We'll talk a bit about some clarifications from the commissioner about the special relief we've discussed a couple of times here before, involving problems in concrete and foundations that were laid in Connecticut. We're going to find out, how that works, in addition to being able to claim the casualty loss deduction in 2018, even though the Tax Cuts and Jobs Act removed those such deductions, except for those from a, presidentially declared disaster area. The commissioner had to deal with the question, well, had they paid it in 17, they would have had net operating loss they could carry back. Do they still get that treatment? So the commissioner will talk about that. We'll talk about the PTIN renewal dates that opened up this week. And we'll talk about a taxpayer that tried to get but was unsuccessful in getting innocent spouse relief. All of that coming up this week on the current federal tax developments. With that, let's take a look at our first case here. And this is a case of retirement accounts in divorce, how that ended up working. This is the case of In re Brian A. Lerbakken, U.S. Bankruptcy Appellate Panel for the 8th Circuit Court of Appeals, which issued this opinion on October the 16th of 2018. This is a case that's not all that different from what probably a lot of you have seen before in your practice. A taxpayer and his spouse got divorced. As part of the divorce proceeding, the taxpayer received a portion of both the IRA and the qualified retirement plan account of his spouse. The taxpayer then later declared bankruptcy. Interestingly enough, one of the people that he owed money to were the attorneys that helped him in the divorce. They actually are one of the parties now moving here to try to get the money. And they were set, the question became, was that considered exempted from creditors in bankruptcy? The court noted that we had a case a couple of years back in the Supreme Court, Clark case, where the U.S. Supreme Court in Clark had said an inherited IRA, an IRA inherited by a non-spouse was a fact pattern in that case, was not qualified for bankruptcy protection because it did not represent retirement accounts. The 8th Circuit Appellate Panel here, Bankruptcy Appellate Panel, took a look at this case, and what they decided was, in order for funds to be protected under bankruptcy, It has to both be a basically non-taxable account under federal tax law, and the funds must be retirement funds. They noted that in Clark, the funds were clearly in a retirement account, but they were not, the court decided, retirement funds because they weren't funds for the retirement of the individual that inherited the IRA. They were instead intended for the person who had, for that individual who had originally funded the account. When that person died, his or her retirement no longer mattered. So they said the protection goes away. The Eighth Circuit Appellate Panel looked for the first time at the question of whether the situation was different if the funds came from a spouse in a divorce proceeding. And the Eighth Circuit decided the answer there was no. They were still in a protected account, but they were not Mr. Lerbakin's retirement funds. In fact, what the court decided in this case was really what they represented was property settlements in a divorce, something that is not protected in bankruptcy. It was just part of the property settlement. This is part of the property of the spouses. He got a portion of what had been her retirement accounts, but that was simply a division of property. That division of property is not, in the view of the Eighth Circuit Bankruptcy Appellate Panel, protected from claims in bankruptcy. Now, that's interesting because, of course, this kind of expands on the Clark case, and it does suggest, be a little careful. We are not attorneys. At least most of us here are not attorneys. And we really shouldn't be delving into this area. But quite often people, have kind of off the cuff said, oh, yeah, IRA accounts after the Bankruptcy Reform Act, they're fully protected from creditors. Be careful there. From the Clark case forward, we don't know if it's not your retirement account. We don't know what the protection is. Our Supreme Court tells us if you simply inherit the account, you're a non-spousal beneficiary. Clark makes it pretty clear those aren't protected. And we're not sure, but obviously this logic would suggest that even spouses may have trouble. This is obviously one that was at the end of the marriage. Whether the result would be different for a spouse, where the court would see it different, for a spouse following the death of the other spouse, was this meant for joint retirement? That's tough to say, but we will say that Brian did attempt to argue that, in fact, it was meant for joint retirement, and so that was their division. They just gave him retirement funds. The court didn't buy that. They said, we're not going to go into what you thought it was for, what you plan to use it for. That's not our inquiry. The question is, are they retirement funds per se? And the answer is no, you are getting a property settlement. You don't get protection. Next up, an announcement from the Office of Management Budget's website, posted on October the 25th, 2018. Under Section 163J of the Internal Revenue Code, added by the Tax Cuts and Jobs Act, we have significant limitations on interest can be deducted by businesses that have average revenues over $25 million. Now, there are some carve-outs available if you have a flooring interest account and you're a car dealer, a boat dealer, a farming equipment dealer, as recall, are the three types that can get it. Other flooring accounts don't count. Actually, I had that question come up earlier this week in one of the sessions, and no other type of accounts, even though they may be flooring interest, won't count. They're going to be subject to limitations. We also have some ways that if you're in a real estate business, you can opt out with a negative, basically on your future accelerated depreciation. Similar issue for farmers who can opt out, but again, with a negative on bonus depreciation for certain property. What we have here, though, is we don't have these regs. These regs are clearly crucial. The IRS had suggested at the American Bar Association's tax section meeting in Atlanta early in October that we were going to be seeing regulations on this, and they're going to be part of a package of regulations, or just, this flood that's going to come out, that we expect to see 1,000 pages of proposed regulations by Thanksgiving. Well, this would be part of that package. Now, we say we think it'd be part of the package because OMB did not indicate that this was covered by the 10-day rule. As you may recall, OMB just recently started reviewing IRS regulations prior to publication. And generally, they have 45 days to review them. But if things are considered significant guidance for Tax Cuts and Jobs Act, they're designated as such, then they have to get it out in 10 days. There's no indication on their website that this was indicated as a significant guidance issue that they have to move in 10 days, but the IRS did tell us they expected them out by November, so we'll cross our fingers. I should say, a couple of things there. you know, it's essentially some key issues in this regard. Um, it's not clear how this is going to work. Specifically, it's not clear. We have some 10-day rule issues. We also have some issues with regard to how does this work for net operating losses. We get to loss limitation rules. Are we, I should say, how does it work in some of these issues? We've got that. Actually, that one's not an issue here. We expect it to be out by the end of November. At the end of November, we expect these regulations to be out and gone, but they do not include partnership or S corporation rules, apparently. And that's where there's some unusual rules in this area, because partnerships and S corporations have this kind of odd siloing effect, where if you have excess interest from the partnership, that you have excess interest from one partnership, you have another partnership that has no debt, has tons of income. You can't take the excess interest from the one partnership and use it against the income from the other. But interesting enough, according to the law, I can take the excess income from that partnership and use it to free up some interest that I have outside of passthroughs. If I have interest, otherwise incurred in the business, that's kind of an interesting area. But unfortunately, that's not in the list of things they're supposedly going to talk about. Now let's go back to those crumbling home foundations in Connecticut. We've discussed this a couple of times. We have a letter from Commissioner Reddick to Representatives Courtney and Larson of Connecticut. The letter was issued on October 16, 2018. The offices of those congressmen released their guidance the same day. Under Revenue Procedure 2017-60, the IRS gave us special procedures that allowed those impacted by the crumbling foundation problem. You may remember we discussed that a couple of times here. I'm not going to try to pronounce the name of the stuff that's in the concrete that causes the problem. We've done that a couple of times. I probably clobbered the name, so we're just going to leave it. But that crumbling foundation problem, if you're in Connecticut, you know what it is. We got a simplified method of doing that in 17. After that Rev Proc came out, though, Congress passed the Tax Cuts and Jobs Act. Tax Cuts and Jobs Act removed any deduction for casualty losses, which would include this type of loss, beginning in 2018. The question became, well, wait, we just found out about this rule late in 2017. People need to get these inspections done. They need to figure out what's going to happen. They then have to actually get the repairs arranged for. It's going to be costly. They're going to pay for them. It's going to take a while to do them. They'll end up paying for most of these in 18 or later. Can't we, is there any way that we get relief here? The IRS in Revenue Procedure 2018-14 provided that, yes, if you pay it in 2018, you still can claim a casualty loss. The representatives and the Connecticut Society of CPAs, noted that there's a problem. And I suspect, having been around state societies before, I suspect the state society raised the problem, and then the representatives came along with it. The question becomes, in many cases, this is going to be extremely costly repairs to do. And those repairs are probably going to wipe out the taxable income of the taxpayer for the year in question. So the problem is we wipe it out, but that means they don't get the benefit of a good chunk of it, unless we can treat it as a net operating loss. And, in 17, we could have carried that back 2 years. So they asked Commissioner Reddick, does the relief you gave us in 2018-14 actually indicate, can we get an NOL carryback? For an NOL, first, can we get an NOL? Secondly, can we get it carried back? And the answer from the commissioner is that, yes, the guidance contained in 2018-14, as he's interpreting it, would allow you to do the carryback, would allow you to take the NOL. We're just kind of opening up in that. As I noted, the Connecticut Society of CPAs was involved in making this request. As I say, I think that's important. I want to point this out because I hear a lot of people from time to time wonder what in the world their organization does for them. Why should I pay into this? Why should I pay dues? What are they doing? Things like this are what state societies do. And more importantly, the volunteers on the state societies. By the way, yeah, volunteers. People who do this stuff for the most part, yes, there's staff that is paid, but the volunteers are the people that really know the technicalities and get deep into this. This is exactly the sort of thing that you get from having a society of CPAs in your state that can recognize this is a very specific issue. It's one that really affects people, but in a very narrow area. It's not as if the AICPA would never worry about it. But given all the other things happening this year, and given the number of people it's going to affect versus number of people affected by, say, the travel and entertainment rules, or the rules on the interest limitation, or the rules on 199 Cap A, this is not going to be one of their key projects. This is the sort of thing where the Connecticut Society of CPAs actually performed a service not just for CPAs in Connecticut, but also for those who live in Connecticut, certainly those who have this foundation problem. So I suggest you consider, if you're not going to be part of a membership of an organization like that professionally in your area that can get these things taken care of, who exactly is going to do this in your area? Just a consideration. Hey, it's that time of year again. Actually, a little bit earlier this year in the past. Usually they open this up right around Halloween. This time they were a little bit earlier. In news release IR 2018-207, the IRS announced that we are now open for business to renew your PTINs. The PTIN Renewal program is now online. You go online at the IRS website, e-services, and you process your PTIN renewal. Now, as we know, you go ahead, you get that done. You still have to do it. I realize the fee went away, but you still have to do it. So we still need your renewals to do. Your renewal should be done by the end of this year so that you're able to process returns right away beginning in 2019. Your ability to be a paid preparer disappears on December 31st of 2018 unless you renew your PTIN. So, don't put it off. Don't say, I'll get to it later. I'll get to it sometime whenever. Lots of things are happening. Just go ahead, decide, and renew your PTIN. You can do it online at www.irs.gov/PTIN. That's probably the easiest place to get it done. Recall that, the PTIN, the ability of the IRS to require a PTIN is not really, the courts have backed that up generally. What they didn't back up was the fee, but the service has continued and the PTIN program's in place. The other thing to remember is make sure all preparers in your firm understand about the need to go get it renewed and do the renewal. That's going to be key for all of those reasons. More OMB guidance news. The OMB put out a list of tax projects through the middle of next year on their website on 10/23/2018. And one of the things that got added to the list are the loss limitations under Section 451L added by the Tax Cuts and Jobs Act. Let's remember what that says. If an individual who's filing a married return, filing joint, has total net business losses for the year in excess of $500,000, or if they're filing single or head of household or married filing separate, that number drops to $250,000. Any losses in excess of that limit are disallowed in the current year, and they're picked up as a net operating loss in the following year. We're going to need some guidance in this area. Okay, we have a couple of key areas that we're going to need some guidance in. Couple of things that have been obvious that were written up in an article in Tax Notes this week that described this coming out from the OMB. What about the NOLs and the limit? In essence, once we can, let's say we have a $2 million loss, okay, $2 million net loss in 2018. So we claim our $500,000 and we have a $1.5 million NOL going forward to next year. Let's assume we have $10 million worth of income. So the 1.5, would be, could be used the next year in its entirety. Are we allowed to use it in its entirety? Or assuming we have no other trade or business income, is the NOL going to become a trade or business loss that's also subject to the $500,000 limitation, which means we're going to use $500,000 of the NOL, if that's less than 80% of our taxable income, and the rest, so then the $1 million would go forward to the next year. The law itself is not clear on that point, and people are wondering how that'll be handled. A second issue that we wonder about is, let's say that we have this $2 million loss. It's in this partnership. Okay, we have all these $2 million losses, but then we turn around and we sell our interest, right? So we've accumulated these losses post 2018, right? We have that. They're passive, but we totally sell our interest now, and we sell it at a net gain because that passive loss has been primarily from the depreciation interest deductions on the building, but the building's appreciated. So when we sell our interest, we actually sell it for more than enough to cover all of that. Question: is that sale of entity interest, let's say sale of S Corp stock, is that going to be considered some or partially a business gain, or are we going to treat that solely as an investment gain? In which case, then we're still going to have a problem that we have, we sold it for a $3 million gain, but if that's not business income, then the $2 million passive loss released is going to get trapped at the $500,000 level, and the rest goes forward. We do not know how that will be handled. And that potentially, probably not for many people, but potentially could have an impact on your 2018 returns. Now, this is a good news, bad news situation. Good news, we're expecting guidance to come in these areas. Bad news, we don't expect the guidance to be issued, according to the OMB, until June of 2019. What that means is for your clients this year, when they say, okay, we have this $2 million loss, now next year they get to 1.5, the answer is, we don't know. Unless you have $1 million worth of business income. Otherwise, I don't really know if you're going to get the full 1.5 million. You may be limited to 500 again, so we may be spreading this out over a number of years, or we may not be. We don't know, and we won't know till next June. So for year-end planning, or for the questions of, just figuring out when people come in for their returns, what you tell them about what's going to happen, that's going to be a problem. Secondly, if you have entity sales this year, that is a problem. Is part of that gain considered a business gain, or are we going to consider it not a business gain? Especially with S Corp stock, where what we're selling is clearly just the stock. We don't look inside to find things. Under 1411's regulations for the net investment income tax, we did look inside, or kind of. It's an oddball set of rules, but we do consider part of that to be a business gain, or basically a gain from a trade or business, not a investment gain. So we're going to have to see how we get that, or what may happen. But keep your eye on this ruling, because the 451L loss limitation rules next summer, if you sell an interest and it really matters this year, that might be one you're going to need to put on extension, and then hope when the guidance comes out, you can then figure out how you should file it to end the year. That's going to be a real problem, because when you come to April 15th and you're looking at what you should pay with an extension, you got to make a call which way you think it's going to go. There's always a possibility the IRS could issue notices in the interim, and we can cross our fingers that they'll issue a notice or some other guidance that will make it clear to us how to deal with those things. But don't bet on it. Remember, when they first passed the law, the IRS said very clearly, it's going to take us till the middle of 2019 to be able to complete all guidance. So this is not outside that range they told us. They consider this not to be as high a priority of guidance, so it's being pushed to the back. Now let's talk about our one case for the week. Well, our second case, actually, because we had that IRA case. But this is the case of Shorts versus Commissioner, Tax Court Memorandum Decision 2018-176, issued on October the 22nd. In this case, we have a couple, right? Married couple. Spouse was a physician, and she was married to an individual who was not a physician. She has an S Corp. He had an S Corp. He basically normally prepared the returns, but he received the information from her and her accountant to prepare the returns. They kept their own bank accounts, etc., but they also had a joint account. Their kids attended an expensive, a rather expensive private school, had expensive daycare. They also did some hefty remodeling, and they used tax refunds for that. Now, what happened in a year was one of the, here as we go for a few years, her S Corp, the wife's S Corp, showed big losses, right? She was taking salary. The S Corp showed losses. Her advisor gave him a copy of the K-1, but they informed him that her losses were going to be limited by basis, okay? That she couldn't claim them all. So they wouldn't be fully deductible by basis, okay? Now, when he got that information, he on his own ran a little desk check, and he looked at what their tax liability would be if he did not claim those losses, and what the liability would be if the losses were claimed. After reviewing that, he then sent the materials on to his tax professional, who then prepared the returns, and he told his professional that, in fact, the S Corp loss was fully deductible, instructed him to deduct the full loss. So his preparer did claim the full loss. The IRS examined the returns. The IRS decided that she didn't have basis, just as her preparer had said, and they came back looking for money. Now, here's what's interesting. Obviously, this relates to her return. And by the time this got to court, the couple were divorced. And so we have the issue here for a divorced spouse. Now, generally, divorced spouses can get innocent spouse relief if the item pertains to the other spouse. The other spouse is, obligated to pay under the divorce decree, and you weren't aware of the problem. The court said, here's your problem. You were clearly aware of the problem. You're aware of the problem because her preparer told you that you could not claim the loss. She didn't have sufficient basis. When you got examined, the IRS determined she didn't have sufficient basis, the exact problem you knew. You knew that by claiming those losses, you would increase the refund, which, by the way, you then know how much you'd get back. And, oh, by the way, those refunds were used to improve the home. So, you knew very well what was happening to them. It's like, yes, it's her money. Yes, it's her situation. Yes, you're not allowed to do a deep dive into her books, but the problem you were aware of. So you cannot get, if you were aware of the understatement, you cannot get relief if you're divorced, merely by being divorced, unless you can show some sort of, as I recall, the one exception is if you were coerced. And obviously, he wasn't coerced. His preparer prepared the return. There was nothing here going on. She signed off on it. There could be a possibility, though, for equitable relief. Okay. Equitable relief applies when you don't meet any of the requirements. This under 6015F. The court said this one's a little more interesting because there are factors. He meets the basic requirements. So we got past the first level. Now, the question was, did he meet the other requirements? And the court did look at things. First, she was legally obligated under the divorce decree to pay the tax. So she's supposed to pay the tax. Now, by the way, does that mean that the IRS can't get the money from him? The answer is no, unless he gets innocent spouse relief. Why? He signed a joint return. Now, if he pays, he would have an action in state court to get money from her, but that's a different problem. So she was liable. It was her money. She's supposed to pay it under a divorce decree. We didn't know if there'd be hardship. We didn't know about some other things. But the court said a couple of big factors that work against you, though, which are also in the list of 7 factors, is number one, you did benefit from the refunds. You knew that you'd get more money, that there'd be a larger refund if you put the loss on return, which you instructed them to do. Secondly, you knew that you were going to use that money for the improvements of the home. You also knew you had some fairly hefty bills for private schooling that you need to use, in which some of that money was used for. It's like you benefited from this. You can't say there was no benefit to you. Also, you clearly knew about it. This is not something that you didn't have an idea was coming. So the court found, because he knew about it and he benefited from the refunds, that even though some factors worked on the other side in this case, overall, he was not qualified for innocent spouse relief, and they denied that relief to him for the years that were in dispute. There was 1 year, late year last year, I think they were married, that the wife agreed that innocent spouse relief would be okay for him for that year, but not for the early years where there was the big amount of tax due. Okay, so innocent spouse relief was denied. Well, we're here in the fall now, and I could tell you, having been in the Northeast this week, actually, I came back from Boston, like I said last week. So I've been in Boston, I've been on Long Island, I've been in Providence, and I've been in Rochester, New York, and it's a little nippier there than it has been in the past. I arrived today in Boise, and it looks like a nice fall day in Boise here today, kind of cloudy and all those things happening. Now's the time to go get your continuing education from your state CPA society. Be sure to check out what's there. By the way, I want to make a note for you. I recently was asked by the California Society of CPAs to record a course for them that they're going to do on their rebroadcast. And I guess it's a rebroadcast, so it never was broadcast to begin with. But it is going to be one of those, so do realize I won't be talking live. But beginning November 6th, there's going to be a series of three days they'll run this. They'll run it with 2 start times each day. California does that. So depending on if you're on the eastern half of the country, you take the one starting at 6:30 a.m., basically Pacific time. If you're on the west side of the country, you would take the one starting at 8:30 a.m. Although the funny part is, in the past, when I've monitored those courses, I found a whole lot of West Coasters taking the 6:30 a.m. start. CPAs apparently like to get up early. In any event, that's there to be on partnerships and S corporations, basis and distribution issues. We cover that. You will be able to ask questions. There'll be somebody there live to answer questions during the day. I won't be available for all those courses, but I'll be there otherwise. But if you do have questions too, you can email me as well if you take that course. But consider it, because many state societies have basically are part of the agreement with Cal CPA that allows you to register for these Cal CPA courses and get them at the member discount. You can often register with them through your state society's website. So you might want to check for that one there too. I'll be teaching it. You go to Cal CPA's site, just look for my name as the instructor, and you'll find this course. That's where it hides. This has been the current federal tax developments for the week of October the 29th, recorded here from Boise. And if you're hearing this, probably it went well enough, we actually got to post it. Check our updates online, which I hope to get the time to start writing this week when I actually get back home, at currentfederaltaxdevelopments.com. Write things as they go up. Be sure if you have any questions or comments, you can email me at zollers@currentfederaltaxdevelopments.com. You can follow me on Twitter. I'll be at Ed Zollers is my handle on Twitter. And I also follow discussions on the subreddit, reddit.com/ourtaxpros, as well as the State Society discussion groups for California, which is open to anybody right now who wants to sign up at Tax Talk. Also those in Arizona and New Jersey, and to the extent we have some activity going on there in Minnesota. So if you're on any of those discussion groups, you want to post something, hopefully I get a chance to read it and maybe respond. Otherwise, take care. Next week, I may very well be recording this from Portland, Oregon. We're on the road, so there are going to be a lot of on-the-road issues this year dealing with this. I'll see if I get it recorded Saturday or if I'm in Portland on Sunday recording this thing, whichever way it works. But be sure to join us next week for more current federal tax developments.